That's right. Uh, let's take a look at today. All right, so if you remember this morning, yesterday, bullish overnight, we pushed up, we hit all of our targets. That was great. Then we're in a bullishy neutral. This morning, we needed to see if the bulls could establish their control over tension, if the bears were going to come in and take out the bulls, what needed to happen. And this morning, we had right off the get-go, we pushed up, couldn't find any bears, and we had our first sample right there, and the bulls did nothing. So this was our nod, and the first opportunity the bears saw, they were like, all right, the bulls are moving out of the way. Let's go in and grab some liquidity. The market pops up. Here's our first bearish sample, and their objective is to pump tension down. This is elastic. So they get a nod, and then they need liquidity, which they got, and then the market is elastic. So your first target is here. The market essentially pushes down. The bulls get a couple of samples here, but not looking at them until daily tension, or 30-minute, gets to zero. And that happens right through this move down and then pops back up. So these bulls here, they get their sample, they wait a little bit, and there's a little bit of a response here that you could look at and say, oh, is this the bulls? The bulls coming in. But there's no impact whatsoever on 30-minute tension. They did nothing. There was no defense, nothing. And it was too early in the day for that to happen. So if this had kind of happened here at the close, then overnight something could have happened. Or if it was a little later, this is early in the day. If there's no response, you knew at that moment, well, tension's going to be way under zero by the time you guys do something. So the bears took this opportunity to run the bulls. That's what you do. This all happened what I think was pretty quick. We get from a nod to right in here. This pops up. We get a sample. There was some volume here, but I like this little bit here because it was not at the same time. It was just after. The bears come in, and their objective now is to pump the market because the bulls didn't impact 30-minute tension. They failed to defend probabilities. And so they start pumping, and they're going to try and liquidate these. And their objective is to look at the origin, especially since we're still so close to it. That was, the first, and then we had a root position here. So first they get right down, they hit the stops here from this root position, which may or may not be there since the overnight session tends to change the way things work. And you take a look here. It's really slight. It's hard to see, but if you're watching it in real time, it's a little easier to see this. But there's a little bit of acceleration right here in this curve. And that's as we blast down here. And they're taking out just anyone sitting with a stop or a break even, and that huge pump down on tension right here just shows you this push down was built off of taking out the root position and pressuring this origin position here. This is what they were after. Because they saw the bulls failed to respond, because they had some people trapped in and they had targets, they went ahead and went for that. Now, the goal here is, again, just to continue to pump. So after they wipe out all those positions, the acceleration slows down. It's to start looking around for what's next. There's just not a lot of opportunity here because we still have velocity down. It would have to move up. You can see it was kind of targeting. Again, we're going to have to move up, get some bearish samples, potentially some bullish samples, either velocity or decay. So the other thing that's happening right now on a not major, but longer term, is they're testing out this margin call low. I didn't think they should test this out if the market was going to stay bullish, but because the bears were able to come in and get this to flip over and start pumping, they're testing that low, where that we had margin calls. Sorry, my face. The margin calls right here. That's what they're after. This low had all those margin calls. The some bullish players were able to come in and buy into those and use those to drive prices back up. That's what they're after right here. We're testing out those margin, not just testing, but we're testing out those margin call lows. And that's one of the things that the bears can use as an objective. There's a lot of liquidity there. Because of who's participating in that low. So now that we pushed down and we've at least tested what I would say the expansion bar target, which is somewhere in here. You're going to have to look, you'd have to pull up a closer time frame so that you could see where that you have a lot of up and down, and then there's a spot that didn't get tested. And there is an expansion bar target in there. It's a little difficult to see even on a 1 minute chart. But if you pulled up, this has likely retested that expansion bar target. And the response here is allowing some market makers to unleverage themselves, which is creating this knee-jerk response back up. This is expansion bar stuff. It shouldn't surprise you. It shouldn't shock you. This is what always happens when we tag expansion bars. And that the market maker low definitely had some in there. I just didn't think it should test it while we're in a bullish sort of things happening. Once that flips over, that's an immediate target. The next thing to happen here is for the bears. So they got these. They got them all under. We had right here, which is a trend cap. A trend cap is during the middle of the day when you have both of them flip over. And this tends to put a real major... It's a real big problem for whatever the trend was before when they both flipped together like this. The bears are going to need to, again, establish themselves. They got daily under. Sure, they did that before. Last time, though, the bears came in like here and got wiped out immediately. This time, the bears came in here and were able to be successful. So in my opinion, this one really didn't get any work done. Today got some work done. They actually did work. They actually took out bulls. They actually pushed new lows. They actually pumped tension. And it wasn't because of some large institution. They did get that work done. But this is the first day. So we need to have another day. I need to see them actually get some work done tomorrow. Otherwise, you know, this is just a big, huge range, and we'll just be hanging out in this range for a while. I think that tomorrow we're going to need to see that again. More work, which means trapping in bulls. The bears come in, they wipe them out, they get some new lows, they're able to push things further. I think they're running into problems, and I think there is some very significant positions sitting right here in this low. Because of the way that it's set up with the margins and all that thing, I think there's some major positions there. So this is going to be a little bit more than just how much cash do you have. It's going to be more about like what's the structure, longer term. They're not going to be the kind of people who are just going to shake out. So I think this is going to be a little bit more work than maybe many people realize. So essentially what the bears need, something like tomorrow, we could have it pop up and the bears could be, you know, tension could even open like here, and then they need to get that to pump down. They need to get further, or they could have it open sideways and just continue, or here and continue. Although I think this is the hardest one, because at 53%, there's not a whole lot of room to just keep going. You can't run a 53% all day. You'll be at plus 70, which is a very high number, really quickly. And then you need some big major news event that's going to knee-jerk a bunch of people. So I don't think continuing like this makes sense. I think this one's hard too. I think this kind of thing makes more sense. Or if we have the market open and it sort of does this, and we have maybe a pathetic day and then it continues down. This kind of thing makes the most sense. So we're going to need some move back up if the bears want to have a sustained, continued bearish trend. So they're going to need to show us that tomorrow. One day, not even a full day of having daily tension down isn't enough to establish a trend. It's enough to destroy the bullish trend and the bulls' control over the market, but it's not enough to establish a trend. So I think we need some cool off here. So bouncing off that market maker low, I think is a pretty sensible thing to do if you look at daily tension. It's like, well, cool it off a little bit. And over the last couple minutes, we're not going to get velocity up, so probably tomorrow morning, this will be the first thing to watch. It'll probably move up, give us a sample since you're waiting for it all day anyway, and then right near or at the open, we'll see a bearish sample right off the open, but they're still going to need to catch some bulls. Remember, they liquidated this group. They don't have anyone else down here. They need some bears or bulls to come in and pay for any further moves down. That's how this is going to work. So they'll need some bulls to come in and they'll need to trap them out tomorrow morning. Looking at the profile here, we cleared out that expansion target that was hanging out here. Let me zoom it out a little bit. You can see right where it hit, right there was this first move down. That was right when 30-minute tension was hitting zero. They got the expansion bar target to hit. It's expanded twice in the same direction, which honestly, I don't think I've ever remember seeing basically one continuous move having two expansions on it. I don't recall ever seeing that. So really interesting. Heavy volume, expansion, expansion. So we have some targets up here that we can mark. Let's see. This one is here, which is just on the other side of a node. This one is hiding behind this label. I need to zoom in. That label's in my way. Yep, it was. So it essentially broke right there. Okay, so we have two expansion targets where the market moved so quickly on a certain type of volume that, you know, these are going to be the places where the market's going to want to get to, here and behind that label there. They're not something you just buy into and say, oh, it's going to hit a target because it's a target. If the market flips into a situation where it's bullish, those are places to pay attention to. Like this one, when it hit this target from previously, you know, there was a response there. And that's pretty common when you hit an expansion bar target. So this is interesting to me. Another thing that was a kind of this is right here. This interest rates plummeting again. We had already yesterday. This was very interesting. And then to see that sort of interesting nature, the aggressive move down in interest rates happen twice. Amazing. So this is extremely aggressive. I listened to some of the things that Yellen said and some of the other things that are going on there. And there's a lot to unpack there, but comes down to is having the interest rates come down like this, I think looks like major restructuring of positions in the markets, wherever that they are. Like I was saying yesterday, the way I look at this is sort of paying off your credit card. This is whatever, I don't know why I'm using American Express. Maybe they branded to me so well, but you pay off your credit card. Whatever positions you are using to position anywhere, the first thing that happens when you close a position is you pay off your credit card, because that's what you do. And that's why those interest rates come down like that, and sweep down like this. These major repricings, not a move down like this, a major repricing like that shows a huge flood of volume coming in. And it's a lot of that cash just coming back. They printed that money, or they created it or loaned it, whatever you want to call it, to use those credit cards so that institutions and people could go do things. And I look at this in the financial market, not in like the retail, public, actual real market, virtual market. They come in and they want to buy a bunch of shares here. And, you know, right now, if we go to the futures and you take a look, this is what it's going to cost you for one. And if you're opening up a 100 or 1,000, you know, we see institutions with 1,000. 1,000 shares doesn't just cost you the margin. It also costs you your risk, your capital requirements on your end, and any other. So I mean, this is a massive position for this type of stuff. It's going to be more like 20 million or something like that. Probably more than that, because that's going to be this here just to cover this kind of thing. The capital, you're probably looking at more like 100 million. I mean, you really don't want to be picking up 1,000 contracts if you don't have because you're going to have to do other things in the market. You're not just buying here. So the requirements are extremely large. And when people take positions on that, it affects the interest rates in a sweeping or aggressive or a really exciting way. And the whole point of these bands here that you see, this curved standard deviation, isn't to give you signals. It's so that you can detect this kind of stuff immediately without any thought. You can tell that this is boring, this is boring, this is a little bit interesting, this is getting a little interesting, it's up in that upper area. That's the whole point. It's not to trade off of this at all. It's just you can easily detect that kind of stuff. You can see that Bitcoin is, if you saw these bands yesterday, they were a little bit lower. Well, yeah, they reprint. The point isn't trading off them. It's so that you can glance at the rest of the market and see what's interesting. Bitcoin is not quite as interesting now as it was yesterday, just the way that this has worked, because this is impacting how interesting this is. And that's true. So I can see right now, just a glance, that this is the most interesting thing across the market. This is the interest rates plummeting, and that's coming down because I think a lot of people are covering out their equity positions on, like, the monthly charts. Huge, massive cash and capital rotation. They're pulling that cash out, and they may very well re-swipe the credit card and take in more of that debt cash. But most likely, if you're going to dump a position, you're going to eat up dollars first. You'll see the dollars come up before you see the interest come up. You want to, if you were to buy here, let's say, you're going to use actual savings account kind of money, whatever's in your actual account. And then you use up that first. The market moves, it comes back, and then here you use debt. And you have a cash average down here. So all you have to do is make sure that you have enough profit in this area here to cover interest. So this cash average is going to move up just a little bit to cover the cost of owning debt. But the point is that if you pay one, let's say it costs $1, you get to pay $1 here. To hold 2 contracts, you get to pay $1. And then if it does it again, you get to pay $1 because you're using debt money. So you can hold an unlimited amount of contracts for the exact same amount of capital. That's super valuable in longer term trends. It's not valuable in little tiny short term trends because intraday debt matters. Daily debt doesn't matter quite as much, especially if this gap we're talking about is 100 points. The market's not going to fold over to wipe out your smaller debt position 100 points. So if they're unloading positions, which we can see here, the next thing will be to use up this, and you see demand, because you're going to want to grab your dollars. I'm sorry, I have that backwards. We want to see supply, because you're going to, this gets tricky. Your savings has dollars in it. You want to give those back, and you want to get, the market's going to give you shares. So the market now has inventory, and the dollars will come down. That's okay. So that's ours. So the dollars should come down as they're getting rid of their dollars for shares. Though, depending on the position, it could go the other way. If cash is coming into the United States instead of from a savings account within the United States, then the dollar is going to get a totally different situation. Okay, so I'm going to be watching. At the end of the day, I really don't have to do this analysis. What I'm going to be watching for is this dollar to get interesting. That's what matters. I want to see it get it interesting, and that's going to tell you a little bit about the more major positioning in the markets. That's going to be when you're like, oh, okay, there's a major position. Usually there are not major institutional positioning on the dollar in equities unless we're at like an insane extreme low. So this does not constitute that. What we have today. We need something massive like the pandemic or some huge sell-off or something like that. Then and only then that's when you start to see those institutions getting more interested in that. So I think that a lot of this downside movement, which has helped these bears, has to do with the fact that there was a lot of profit taking here and the interest rates coming down to make debt money look cheaper because they have excess because they're getting it back. Okay, let's take a look here. And I did see some interesting stuff here. These are in the money. These are not the same as out of the money or at the money. They cost significantly more because your premium is this. It's your extrinsic, and then there's going to be a little bit of intrinsic on the top of it. The point is that you use this type of thing for a hedge because you can get into a positive spread. A positive spread is where you have a short up here. I'm saying short because of we're bearish. You have a short here. Your strike plus your premium gets you up to here, and there is actual there's distance between your short position and your what I call the break even of that put. You have a positive spread. There is no way to drive you out at a loss. None. And the reason that's important is because hedging creates support and resistance. I can draw a level. So right about here, this level is going to be difficult to push above because these people, which there are like around 4,000 contracts sitting right here, if the market moves above here, the market cannot, who's going to, like, this short position is going to lose money, essentially, not take a loss. But if we move up to here, this short position could actually transfer cash away. But once we get to this point, the break even of this position where the option starts moving 1-to-1, what happens is suddenly this position can no longer fund a move up. So anyone who's short from there no longer can fund that move. So the market herself becomes liable. The market has to come up with the cash. So it creates a resistance. Markets don't want to go up there if you have somebody in a positive spread or a negative or a positive spread. It won't want to go up there. That's creating a resistance. And you can see that there's 3,000 sitting right here. We have another level right here. Somebody hedged. And at that point, the break even is going to be just above there. Again, markets are not going to want to pay for that. We had 1,000 here, which is not nearly as much as these ones. These are the ones I'm more interested in because they're larger. This one's okay, I guess. So these are spots the market's going to have a difficult time with. It's going to be tough to move up there. The bears, which bears? These bears, we can point to them. I know where they are. Right there. This is the group. There are no bears in here. I didn't see any positioning or any, well, you know, that's not true. We did have this position here. It was that one. Then we have the bears here. So there's bears there. There's these two groups right here. But this group got liquidated overnight. That's why I'm like, yeah. I am looking at this group. And anybody who happens to be short up here. Just anyone who's short from any higher potential price. We can see that they have hedged. So this is going to create resistance. Now, the way you get through resistance like this is pretty straightforward. You just start over. So what the market would have to do is come along here, find a new bear, a bull comes in, and then use this position to fund that move up. If you don't have anybody new, the market's going to go wee and bounce because there's just no money up there. The market's not going to pay for it. You won't get the market to pay you. So we're sort of just starting over here. Outside of that, we see this again, which this is something we've been seeing. I don't know who it is that's doing this, but you get these stacks of a couple. Let me scroll back so you can see what I mean. Here we go. Again, again, again. Somebody's been doing this positioning. I don't know if it's long or if it's short. You guys could tell me. But you can see there's somebody keeps doing this, or an institution, I don't know who it is, but someone keeps positioning in OTM out of the money calls, and they'll get like 2 or 4 at the same time, and they're always about 2K each level. And so this, I mean, you can see right there, 2, 4, 6, there's 7,000 contracts just plopped down there. And who's doing this? I don't know who it is. So this behavior has been happening again. So we've got this whole situation. Maybe they're selling calls and they're in positive spreads. Maybe they're using their excess capital. They're rotating capital to sell calls and try and consume premium on those. It could be. It's a lot of money. So that behavior has continued again today. So with the bears in a positive spread, it's going to be difficult to take them out. Also, markets have a hard time continuing downward when risk, or it's hard to continue when risk drops. And risk, I mean winner risk. it's hard for the market to continue downward when the winners aren't holding risk. You can't take money out of markets without risk. If you have no risk, you can't pull cash out. So the reason that you hedge like this is because it drops your risk to zero. So you have no risk. You're guaranteed some returns, and you can use this position as sort of a place to operate from moving forward. So they'll need to, again, and this is why when I talk about this, it's like, well, how do you keep this going? Well, again, these guys are going to need to let it kind of cool off. And so having a position like this makes a lot of sense for this kind of situation where you kind of want tension to cool off. Price could move back up, and that way that they're not at risk. We can have that, and their positions are not at risk. If they happen to get that to cool and the next day it plummets, this day did not pressure them. It did not stress out the traders. They were perfectly hedged. Their positions were great. And on a move down, their downside profitability is still the unlimited nature that they want, and their upside risk is zero. Actually, it's negative. It's a negative risk. And the reason is because they've already guaranteed their returns. So if you want to keep going down, you got to trap in bulls, and you got to reestablish your dominance, and you got to turn them upside down, and you have to get them in a losing position. And that has to happen because of the way that's set up. So I think right now we're in a situation where this looks pretty good to kind of to move up and then shoot down. That's why I think that this is the most reasonable thing to see. We see it hit this. It bounced off of it. So hopefully you're seeing this like, oh, okay, well, yeah, it makes sense to bounce off there. The market makers get a cooler position off. Price can move up. We could see it move up overnight. Sure, that's fine. We could see it come up here, do this kind of stuff. It's going to have a hard time rolling above these levels. It's going to have a hard time moving above those levels. And if you're wanting me to, you're staring at this going, well, what are those levels? Let's show the price on, right, so you could see. These are the spots where I think the market's going to have a difficult time. So 39.10 is the higher one. I'm going to look at that one more than I'm going to look at the lower one. 39.10 is going to be the spot I'm paying more attention to, but that's a lot of difference. Even though on this chart it makes it there, that's a long ways. It's 30 points. That's $1,500 return between those two. That is a stimulus check. That is like minimum wage full time. This is a long ways, no matter what metric you use. So I'm going to be looking at those. I think moving up here, we could see this market get up to 70. Here's the 39.10. That's a freaking way. It's like up here. So we could see it hit that. I'm more interested in the higher one because I think that is always much larger, but there's that one. It could come up and do. I mean, this is a lot of freedom the market has to move around after that they position the way that they did. That freedom could get used to cool this off. That's why I'm thinking, hey, a cool off here looks good. A move up here could totally happen. Help that ease off this high level right here, and then we get that to 30. We could get that to 30% without having a whole bunch of damage to the bears, and then repump that either at the end of today, at the end of this day or the next day. That would be the best place to have that happen after it cools off, or have a massive gap up and then just do it tomorrow. That's fine too. We just have price gap up to right up to 39.10. Sure, that could work too. We just do that, and then well, the point is, as long as you know what they're trying to do, cool off tension so that we could have another move down. At this point, if we break this low and this goes like that, big problem. Now, I want to talk about the biggest thing that's happening right now. I have to bring up this right here. All right, so you go over to the Trade Trust Group page. And if you just click on the link, you don't get this cool feature, which is when you click on it, it pops out a chart. And the chart looks like this. The goal is to kind of make it look like a cool chart. I don't know. Anyway, this is a huge problem. You can see our statistical, this is the stat ADI, and we are at extreme levels. basically this is modeling, if you have the advanced decline, and we say, what's the advanced decline? -2449, which is huge. There are only 3,060 stocks about in the New York Stock Exchange, and that's, so not a whole lot of room before everything is down. Statistically speaking, though, if we're going to say, instead of go advanced decline to index, we go index to advanced decline, we recreate the advanced decline based on the index and the way the market works, then you look at this, statistically speaking, this is -4,000. So the market is acting like this, the advanced decline is -4,000, which is more stocks than are available. So what happens is that you can't keep this up. Now, you need to remember that this follows the rules of positive divergence. And if you don't know the rules of positive divergence, listen up. The rules of positive divergence are this. It's divergence, really, but this is... The first problem with positive divergence that you need to be aware of is that they have an infinite amount of time. They can positively diverge forever. So you have to be careful that when you see something like this, that you treat it like a pivot, not like a signal. This is a big deal. A lot of people get this wrong, majorly wrong. You can't assume that a positive divergence means you just pop in and buy it. So I say positive divergence because we have this pushing down, which suggests that there's upside force here. Price is pushing down, but it's getting pushed up. We're starting to see this. And you'll see it more pronounced over the next day or two, probably next day. This is a big deal. The second thing is to treat it like a pivot. So if this pushed down, this pushed up, it could come back, treat it like a pivot, and this is a major pivot. So you need to be careful about that. Pivots happen, and this is with all things that create positive divergence or negative divergence. And the last thing is there is a confirming step. All positive negative divergence tools need some confirmation step, and typically that looks like this. I'm going to use this line right here to define. This is price moving down and then up, and your signal goes like this. So you have this divergence. You need the confirming step, and what that is where you come up out of that initial divergence, and then it comes back down, which almost always happens, and your confirming tool doesn't come back down, and then it goes, and this will go. And this will look to a lot of people like a cup and handle. And that's fine. But your divergence here should have this here, and then you have it where this one sort of comes down a little, but doesn't really come down with that one. You don't want to see your diverging tool do this or something at that time. You want that divergence concept to continue. And that's exactly what I'm anticipating here. There will be a point where this shoots up, and then it's going to come back. And this part where it comes back, so it'll feel like this. It shoots up at this rate. It comes back at this rate. And then it'll do something like that. If our advanced decline here, let me do this. There. If this comes back up, and then during that move back down, it looks like that. So you're like, oh, wow, this price move down was like, I changed the size. There we go. The price move down will be like 80% or something. It'll wipe out a lot of the smaller hands, but the stat ADI will be something like 8% or 5%. It just won't really come back down. This is the confirming step. This is a big spot. I have seen these have price move to a new low during them while the stat ADI does that. This is really tough stuff. Most of the time price will move up and price gives you this move down like that, and it doesn't push the low. Usually that's what happens. But I have seen it the other way around. I've also seen it where this happens. So I'm just going to lay out the few scenarios so that you know what's coming with this. So I know a lot of people are going to be paying attention to this. It could move up and we could see price just dive. And so you see the stat ADI like that. And then the difference here between it turning from support to resistance is that it doesn't really come back up and test it. It dives and you get another stat ADI signal. It's loading. There we go. So you need to be careful of this. The second one, then you get another one and it comes up, and then price will take off after. So this is something we've seen before. The reason that I don't think we're going to get another dive down like that is because I don't really see anything that's a great indication for that to happen. I don't think that there's something going on fundamentally that's going to shake things up that way. Maybe the $15 minimum wage could potentially scare a bunch of people, but I think a $15 minimum wage for the trading economy is extremely bullish. It'll just, so I don't see anything that I think is really like, oh yeah, we're going to plummet here. It could still do it, but I just want to lay this out. The thing to pay attention to is that sort of the confirmation you're going to have, and it looks like this. It's almost always. It's the speed going up. It's instant coming down, and that move down is the one you want to pay attention to. Remember, it's typically overnight. This is when the good fun always happens with the stat ADI. It's overnight. It's during the off session, and I think there's a lot of reasons for that. The biggest one is because less people participate during this time. It's harder to participate. So I think that's why it tends to be during the overnight session. So that's why people are always saying I like to be up overnight, because it's true. So this is the biggest thing I think going on right now. This is a big deal. Pay attention to it. Keep your eyes on it. You could check this anytime. Like I was saying to you guys, like the first thing you could do, sorry, phone's trying to unlock. It doesn't know who I am anymore because half the time I'm using, so like this, see? I have it right there. Boop. You just check it and it loads up. You don't have to log in anything. You can set it as like a home screen link. You keep your eye on it. When you see this move up and that one confirmed, that's going to be the time to act. I'm going to be paying a lot of attention to it. I'll be using the VolTWAP while I do that as well. This is going to be, because that runs overnight too. Okay, so that's where we are. I think right now the market needs to burn off a little bit of that tension. Tomorrow the bears are going to have to reestablish themselves because they went ahead and hedged their positions out. It makes it very difficult to continue, but it also makes it difficult to just immediately reverse back up. So we need some reestablishment of the bears, see if they can continue to control this idea of the probabilities tomorrow. If they can't, then the bulls are going to take that chance to ride this up in an elastic wave up and hopefully get us back up to zero and see what they can do, if they can take out some bears along the way. All right, guys, I will see you tomorrow.